Kia ora, I'm Nadine Higgins and welcome to your personal finance podcast, The Prosperity Project. On this podcast, I'm on a mission to empower you financially. I am a columnist and a journalist, an investor, a financial advisor, and the mum of a toddler. But I do not claim to be the font of all knowledge. I'm still figuring it out too. And that's why I'll be bringing you the experts and mining their big brains for all the things you and I need to know every week. Kiwis are pretty familiar with the idea of investing in property, but more often than not, it's in houses, residential property. But I'm often asked by clients about whether they should instead consider commercial property. And our guest this week says, yes, they should. So what do you need to know about the ins and outs of commercial property? Joining us is the Chief Executive of property investment firm Rethink Group and commercial property investor Scott O'Neill. Kia ora, Scott.
Great to be here. Thanks for having me.
You're welcome. Great to have you. I'm just wondering, what is it that got you into commercial property?
Well, initially it was just trying to find better cash flow because, like everyone, I started in residential property. It was good at the time. This was back in 2010 when I started, but the yields were a little bit better back then. And I guess I was trying to find properties that would help me retire. And as the prices kept growing, and it's the same thing in New Zealand, the yields just didn't keep up. And now that interest rates are higher, the numbers just didn't stack up for residential property. And as much as I wanted them to, I just had to look for alternative ways of building passive income. And it was a bit of a default move to consider commercial. And it changed everything, to be honest with you.
So do you think residential property investment is dead?
It's not dead. It's where you need to start, especially if you're sort of starting with a lower deposit, because you want to leverage your return. So residential property is perfect for that. It's fairly low risk. There's still risk in it, and you still need to understand the opportunity cost of continuing down that, residential route. But it's getting harder. There's a lot of people considering other asset classes due to the price, due to the low yields. Even the fact that you've had such significant falls in many parts of the country, it does just show this does go backwards sometimes. And I'm of the opinion that, the last 30, 40 years of growth might not be as good over the next, 20 or 30 years, because think about what changed. Like, women entered the workforce in higher percentages. That just went straight onto mortgages and pushed prices up. There's obviously a lot more focus on investment. So there's, obviously immigration levels are high. All these things contributed to higher prices. And, one would argue there's probably a little bit less upside over the next few decades ahead.
Well, that's what makes this discussion so interesting. And I've got so many questions for you, but I'm wondering, did it deliver what you were after? You were looking for cash flow, you were looking for your retirement strategy. How has commercial property panned out for you?
Well, look, really well, to be honest. It's mostly just the fact that the yields were on a net basis 2 to 3 times better. And I'll just explain that for the listeners. So when you're looking at residential property, you might look at a property in, say, Auckland, and it says it's a 4% yield. It's really not the net yield because that's a gross return. Mm-hmm. Out of that 4%, you've got to pay for your rates, you've got to pay for your insurance, maintenance, property management. There's all these hidden costs that might turn that 4% really down into a 2% net. Now, with commercial, we're looking at minimum 6% net. And that's because the tenant pays all your outgoings. They have it inbuilt into the lease to say the tenant must pay maintenance, they must pay insurance, all those kinds of things come out at the tenant's cost. So it leaves you with more money in your pocket. And, a 6 or 7% net sounds a lot better than 2% net. And that's basically why my portfolio has been able to scale to the I guess, level it has. Like I started with basically no money, a very small deposit, which it took me 6 years to work towards. And that deposit was 60 grand I saved. And then I just put it into residential, leveraged those returns. And fast forward 15 years, it's now sitting at 110 million in value. And that's it's the net rent, which has allowed it to scale. So it looks like a good equation on paper because we've got long leases, high income from tenants. And it's kind of like running a business. The higher the business income, the further you can go. And, it's not all about growth. It's it's about growth and cash flow. You need both equations working well.
It's a pretty amazing success story over 15 years. I'm just going to take one tiny step back for our listeners. When we're talking about yield, we're talking about the income from the property, so that's from the rent or the lease, as a percentage of the purchase price, right?
Yeah, that's right. So let's say you've got $1 million property and your rent is just over 800, or call it 800 a week. That's 40 grand a year, roughly. So 40,000 gives you a 4% gross yield. And then, your insurance might be a few thousand, and then your property management, a couple of thousand, like all those thousands just get taken out of that 40. And that's where you get back into that net return. So it's extremely important for any investor not just to look at gross returns. This is the commercial investor in me, because they always quote net returns. But residential, we've got this pretty poor habit of forgetting half the equation.
Yeah.
You cannot just say gross yield, because gross it's almost an irrelevant number, because it's not the true state of what you're collecting. So I don't care about gross returns, it's net returns. And when you start calculating every investment you look at back to the net figure, you actually know what you're getting at the end of the day, before tax at least. And
it's like looking at your KiwiSaver investment and not taking the fees of your fund manager into account, right? That's not the bit that hits your bank
100%,
account.
exactly right.
Let's talk about some of the other differences, though. You talked about deposits. And in general, in New Zealand, if you buy a new build property, you can usually get a 20% deposit on a residential investment property. What kind of percentage deposit do you need if you're going down the commercial route?
Yeah, this is probably the largest barrier to entry you'll have. Like, we'll go into sort of the other benefits of commercial property, but I guess one of the negatives is you just need more cash to buy into it. You're generally working off a 40% deposit. I generally tell my clients you need about $400,000 in cash or equity to get into this space. And you can get in for less, but it's just like anything. You start going cheaper, the quality is going to get a bit lower, like, because you're dealing with more entry-level tenants. And we really just want to be, I guess, helping clients into the best of the best deals. And unfortunately, this is not going to be in reach for everyone. This is a space where you kind of, like a lot of our clients, for example, have done, invested for 20 years in residential, and they might sell 3 or 4 houses, or it might be a business income, or they've, maybe they've got equity in their home, they've saved. But look, it takes more money to do well in this space, but you will make more money as a result of that higher barrier to entry.
So you probably just need to be a little further down your investment journey, have a bit more cash, bit more equity. When you say you need 400,000, I know you talked about the prices starting to get out of reach or out of whack with yields for residential property. Does that mean you're kind of talking about at least $1 million buy-in for a commercial property?
That's right. So $1 million, and for that million, you'll probably be getting 60, 70, maybe even $80,000 of net income. So it's a pretty good return on money. And I guess the other good thing about commercial properties, you've got scheduled increases into the rent every year. So, it might be 4% per annum. So that rent goes to 100, or let's say 83,000 the next year, and then it might be 87,000. It keeps going up. And every time it goes up, that's value increases as well, because rent and, I guess the rent is one way of valuing a commercial property. So if you can push your rents up, you can make equity. And there's a lot of value add strategies you can go into that space. Like, you might find an under rented property. Maybe it's a slightly lower yield day one, but then you can renegotiate the lease to bring it to market value, and you can make several $100,000 pretty quickly by doing things like that if you know where to look.
And when it comes to the lending, are you looked at as a commercial borrower, and therefore are you paying commercial interest rates, as opposed to if you're buying residential, you tend to be able to access the same as anyone getting a mortgage on their home?
Yeah, look, it is slightly higher, not by much. I've seen this come full circle in Australia. There's a lot of attention because banks want market share into the commercial space, so they'll get more competitive. But yeah, look, might be 0.5% higher than your normal residential rate. There is also things called lease stock loans. So what a lease stock loan is a loan that is backed by the lease on the property. So you don't need to show your financials, because it's almost like a fund manager. You know how you've got a fund and they've got a loan within the fund. Like, there's no personal guarantee or guarantor on that loan. It's the property is strong enough on its 2 feet to lend on itself, and you might need 1.5 times the interest rate covered to service the loan. But basically, it's like a standalone loan that supports itself. And that actually really is good for, I guess, those who've tapped out of lending capacity in residential, because if you've got equity and they say no more lending for residential, you can actually still keep going in commercial, assuming the asset you're buying has enough income to cover its interest rate.
And so when you say 1.5 times interest cover, you mean the income on the commercial property is enough to cover the interest 1.5 times?
That's right.
On that
exactly.
loan? Okay.
Exactly.
What about the term? And I guess the structure of that loan, will they do that interest only? Will it be over 10 years, 20 years, 30 years? How does it tend to work?
Look, it's always case by case, and it does vary greatly. So, I'd have to answer that fairly generally. But I guess the loan terms are a little bit shorter. We'd like to go interest only. The reason for that is I like paying banks back on my own terms. Like, let's say you got that principal coming up, you're better off sticking that against maybe your home loan or something like that. Like, maximize the debt where you can. And, you obviously might just keep it in a savings account as a cash buffer as well. So it's there if you need it, but you're not actually spending it. So, but everyone's got a different strategy in that part. Like, some like just getting rid of the debt as quick as possible. Some are still in an expansion phase. And when they save enough for a second deposit, you can buy again. So, it's each to their own in that space. But, I guess it is a very big mixed bag.
And if you're borrowing for that property on the strength of the yield from the lease, does that mean that you need a multi-year lease in place before you get the lending?
Yeah, good question, because banks, well, look, they're generally, you can get a bank loan on a vacant property at the end of the day, depending on the applicant. So the lease, the longer it is, the better it is in the bank's eyes. So obviously types of tenants, like lending will vary depending on the strength of the tenant. Like if you've got a little, fish and chip shop versus, Woolworths, it's going to have a slightly different outcome with the bank, because the banks will see that big multinational company as a stronger one than a sole trader. So they might sort of give you a better interest rate or longer loan term. It does. I guess that's one of the good things about commercial property is you could learn what the banks favour and then invest in those types of properties as well, because they'll give you more favourable terms. And it's a way of understanding, I guess, the risk of the asset as well.
So when we're talking about commercial properties, you mentioned fish and chip shop, so I guess it could be hospitality. But is it anything from, the mechanic or the retail store through to the warehouse? That's
right. Yeah, we're over the years, we've helped over 5,000 odd clients purchase properties. So we've bought a little bit of everything in that time. And the assets that we tend to pick the most are like those small type industrial ones. And that could be the mechanic you mentioned. It could be a cold storage facility where they're storing yogurts for Woolworths again. Like it could be anything from like online businesses where they're just sort of doing that last mile logistics. We love medical centres. We love even childcares, like backed by government, long leases, pretty strong businesses. It's just a wide range of tenants. But no matter how good the tenant is, we're always considering, is this property releasable? Because the best tenants can still outgrow spaces. So you just want to have a bit of clarity on what happens when they leave. And the way to do that is just checking what other tenants are in the area, what the vacancy rates are. And the more you do that, the more you get confidence around what happens, when that tenant leaves. And sometimes it's a good thing when they leave, because especially now, like in places like industrial, the rents are growing really quickly at the moment because there's not enough of it. They're not building enough, especially the larger stuff at the moment, because it costs so much to build. So there's a shortage, and tenants are having to pay more and more. So you might lose a tenant, and they might be on $150 a square metre, but the next tenant might pay $200 a square metre. And that's instant equity in that case.
We'll talk a little bit more about the state of the market in a moment. But when you talk about a tenant leaving, it's my understanding that it's quite common in commercial, which is quite distinct from how it is with residential, that you might get a kind of rent-free period in a new lease. So is that the case? And is that something that has a significant impact on an investor's cash flow?
Yeah, good question. So that's called an incentive. So incentives are a form of just almost like you mentioned, it could be a rent-free period. It could be some money to contribute to a fit out. It might be a way of getting the tenant to sign a longer lease. So with an incentive, it's kind of a negotiation tool at the end of the day. There might be, like for industrial, one month free rent for every year they sign up. So if it's a 3-year lease, 3 years free rent at the start, it gives them a chance to move in, sort their stuff out. There's obviously some down trading time, so it's a way of helping the tenant out. So in terms of the impact of that, it's not significant because you generally will collect a cash bond of at least 3 months in place as well. So you've got the cash in the bank there, but effectively it's 3 months you're not going to get paid in the long term. So big incentives aren't great, but they're part of doing business. And I guess the good part of commercial is your tenants tend to stay a lot longer. Like over the years with our clients, we see an average tenure of about 9 years. So one new tenant every 9 years. So compared to residential, you might be finding a new tenant every year or every 18 months. And there's going to be downtime, and you've got to pay your leasing manager a week or two's rent as cost of that. So there's still costs involved and lost in the residential side. So I guess it's similar on the commercial. Incentives can get higher the weaker the market. So like right now, the office sector in the CBDs are pretty weak. So you might see larger incentives there to attract tenants. But the stronger markets, sometimes no incentives to small ones are just what you'd have to factor in.
All right, we need to take a quick break, but after the break, we're going to talk about how the commercial property market is faring, especially compared to residential, amid a soft economy. Back soon. Welcome back to the Prosperity Project. We're talking about commercial property and the things you need to know as distinct from investing in residential property. And we've touched on it a little bit already, but what you've alluded to, Scott, is that the market for commercial property is very strong at the moment. Given that the economy isn't necessarily that strong, where is that strength coming from?
Yeah, it's a great question. And it's not strong in every part of the economy. So I'll sort of go through the three main categories, which is retail, office, and industrial. Start with a weak one, and that's office. So ever since COVID,
yep, we're all working from home.
Exactly. And this is a global thing. It's not just New Zealand, but I caught up with the head of JLL this morning, and he gave me a bit of an update on the office market. And interestingly, there's two categories of office, the main ones, secondary and primary. The primary stuff is like your really nice fit outs, there's almost no vacancy in that. So businesses have had a flight to quality. So they've left the old building to go to the new one.
Because they're trying to, in response. They're trying to tempt us back to the office. So it has to be a nice place to be.
Exactly. It's the only way to do it. Like, you're not going to go to a little red brick thing and, 30-year-old fit outs anymore. People just would rather stay at home, and that's the challenge the older office market's going to have to deal with. I don't know what the solution is there. It's going to take a long time for that to filter out. Maybe you convert some of these old office towers to residential, or, fit them out in a different way. I don't know. There's stuff that will have to be done to fix that. But the premium stuff is really strong. So, good quality fit outs, brand new buildings. They're basically all full, very close to full at the moment. So good signs there. Retail. Now, this is one that a lot of people go, it's weak because there's 4 lease signs and all that. Retail is not all equal because, high street retail where there's no car spots, yeah, sure, there's no real solution that's fixing for a consumer. But what about like your malls or your little neighborhood shopping centers where there's a pharmacy, a supermarket, might have a doctor in there? Like those types of things are going really strong. And when I say strong, they're only coming off, a low base because these interest rates have been cut. So it's only in the last 6 months we've seen it, the tide turn. And this is the exciting bit because it's coming off a low base. So it's been very weak over the last 2 years because prices got so high in New Zealand when the interest rates were low. And then your interest rate went super high as well very quickly. It was one of the most aggressive increases in the developed world. And that had an impact and brought prices probably down 20 to 30%. So we're now buying at a 20 to 30% discount, which that's where it's strong. So it's historically it's on a low price point, so there's upside. So that's the exciting bit for the early adapters or early movers into the investment world there. And retail's got pretty good yields, so there's a flight to yield as well. So investors are pretty excited about that.
So even though the prices have come back and, some retailers will be struggling with the fact that, people are being a little bit more circumspect with their spending, that hasn't flowed through to the yield on those properties?
Well, a lot of it's priced pretty well. Like COVID did a good job of flushing out a lot of those, I remember the term zombie businesses and stuff like that, the ones that were struggling. So there's been a bit of a clean out already. And I guess the retailers, there's obviously always retailers dying because new competition or changing environments. There's always something on the news, but generally it's fairly tight out there. Bad sites will remain vacant. Good sites will always remain full. So you can't generalize as much as you can in the residential space and say, there's a 2% vacancy rate, because a good property will always be full, and a bad one, like I said, like if you're around a back alley and there's no exposure and the building's old, that's probably not going to get filled regardless of the economy. So I guess it's all about the individual asset, and the rents are where they should be. And look, there's obviously many cost of living crisis problems out there, and that rent's one of them. There's obviously electricity costs, there's all of the above, building materials, labor. It's all kind of in the same bag. But I guess there's also a huge amount of new people in the country from immigration, and that means there's more people buying things as well. So from a total population point of view, there's more volume happening. So that's good for bricks and mortar properties.
What I have seen with some clients is they want to buy a commercial property and then lease it to their own business because they are the mechanic or the electrician or whatever. Does that de-risk or add to the risk? Because you've kind of got double exposure there. How well your business goes is going to impact the cash flow of your commercial property.
I know, and it's such a good one. This comes up all the time, and it's a big kind of, people get emotional as much as they shouldn't with commercial, and it feels better to own your premises. And I always just say, keep your investing and your business separate. Like you've hit the nail on the head. Like it just doubles the risk. You've got all of it in one location. And if you're an investor, especially a borderless one, you want to put your money in the best possible area where you get the best yield, best capital growth upside. Is that going to be the exact place your business happens to be? Chances are not. So you're probably going to be sacrificing just because you want to buy where you are. And people will go, well, rent money is dead money. It's only dead money if you haven't invested elsewhere. So you just got to use that capital and invest. Otherwise, otherwise it wouldn't be better to buy if you don't plan to invest, because, at least you're paying the mortgage off instead of someone else's mortgage.
In New Zealand, there's been some rule changes where you can no longer claim depreciation on the building. And look, you haven't been able to claim depreciation on the building of a residential investment for a long time. But is that a significant factor for a commercial investor?
Oh, look, they're the only little 1%ers here or there. You never invest just for depreciation. And we've seen so many rule changes over the years in New Zealand, and there's probably going to be many more as well. And I just don't see that as a material change, because we never really looked at it. It was almost like a little bonus you'd get, when you're reviewing it. It's a new property, you're going to get a little bit more depreciation in your tax return. But there was never part of the decision basis. But it's worth bringing up on that note, there's going to be, I always talk about, there's greater political risk long term for all countries because there's more and more people not owning their home, and that political risk is going to be focused on residential properties. The reason for that is you could imagine when half the, population base are lifetime renters, they're going to be bringing policies to get votes in, because that's all politicians are here to do, to get voted in. So there's going to be more negative long-term taxes or rule changes or restrictions placed on home ownership if it benefits the tenant. So it's kind of going to be a bit of a battleground, I think, and commercial property will be excluded from that conversation because no one cares. I'm generalizing here, but the majority of public do not care about what happens with commercial property. So it's generally outside of the firing line of these policies, and we're seeing many of these things happen in Australia at the moment. But sometimes playing in a space which doesn't have political risk is important, because it's something that most people wouldn't think about, but but I do because I have seen it.
Yeah, it's a very good point, because in New Zealand, a lot of landlords are vilified because they're potentially owning 2, 3, 4 homes when other people own none. Yeah. So you make a really good point. I'm just wondering if we could round this out with, we've talked a lot about the benefits and a lot about the risks. Who shouldn't invest in commercial property? Like, what are the situations where you are not yet a candidate to go down this route?
It'll be controversial, but if you haven't invested before, you're probably not ready for commercial, because commercial property has this ability to, I guess, hyperinflate the good times, and obviously it goes the other way if things go bad. So you're going to get better returns. You will make more money out of this, period, if you're doing it right, because the returns are higher, the capital growth. If you actually look at the capital growth figures in New Zealand for the last 30 years, they're pretty much the same as residential. Like everything's tied to build costs, supply demand of specific types of zonings and stuff like that. So it all grows similar, but the yields are a lot better. So you're going to get a better internal rate of return in commercial. So why wouldn't you invest in it? It's because if you get it wrong, you get punished harder. You will buy that property that doesn't get the tenant, or there's a lease in place which you misread because it's very complicated. And, these are very, like, there's 100 points of checklist you need to go through on every deal. And every different asset has a different risk on it. Like using childcares, you've got to look at what future supply, like, are there DAs for other childcares in the area? What's the, is it an aging population in the area? You really got to understand business. And if you haven't invested in residential properties, or at least stocks, and dealt with the ups and downs of that, then this is just going to be a little bit too much for you when something goes wrong. And a good commercial investor just needs to problem solve. If you do lose your tenant, you don't freak out and sell the asset at its low price point. You got to work through it and go, all right, well, how do I find a tenant? Do I need to change property managers? Do I need to fit the thing out differently to attract a different type of tenant? I don't know. Every asset's different, but it takes a calm head to work through that. And that's where someone who just hasn't touched this asset class before will get burnt.
Yeah, so you need to be a little bit more cashed up and a little bit more of a sophisticated, experienced investor. A really interesting discussion. Thanks so much for your time, Scott O'Neill. Thanks for listening to The Prosperity Project. You can follow this podcast on iHeartRadio or wherever you get your podcasts, and please do chuck us a rating or a review while you're there. For more personal finance and business content, head to nzherald.co.nz, and please do feel free to get in touch with your questions and your stories. nadine.higgins at nzme.co.nz. A reminder, though, that this podcast is informational only, and nothing we say here should be considered personalised financial advice. But also remember that while listening to this podcast is hopefully going to be additive to your financial knowledge, and that is fantastic, knowing stuff doesn't create change. Doing stuff does. So what action are you going to take today to make your life more prosperous? My producer for this episode is Ethan Sills. Sound engineer is Richard Martin. I'm Nadine Higgins. Thanks for listening to The Prosperity Project.